If you have gone to borrow money from a bank, you have had to supply financial reports as part of the process. Your net income is important, and so is your cash flows. But one of the key things the financial analysts are looking for is how likely it is that you will have financial distress. One of the common things the analysts will look at is your current ratio, and we're going to talk about that today. So if you're ready, let's begin. So what is it? Simply stated, it is the result of dividing your current assets by your current liabilities. You will get a number, maybe 1.0, maybe 2.1, or something else. It is not stated in terms of a percent. It's just a hard number. So why is it important? What the analyst is trying to figure out is how safe your business is. How reliant are you on current sales and profits to pay your current bills? If your ratio is very low, it tells the analyst that if your sales were to drop in the next month or two, you may have trouble paying your bills. The primary assets in the current assets group are cash and liquid investments, accounts receivable, and inventory. These items are current because they are expected to be turned into cash in a short period, definitely less than 1 year. The primary liabilities in the current liabilities group are accounts payable, your line of credit with the bank, and the short-term portion of the long-term loans. The short-term portion of long-term loans are the principal payments towards those loans that you will make in the next 12 months. These current liabilities are what you have already committed to paying off relatively quickly. Unless you have some strange barter system worked out, everyone will only take money. Your current assets are the only things that you have that can quickly be turned into cash to pay off your debts. In order to generate cash, you need to have your assets make you money. The normal way of doing this is to sell your inventory to your customers. Think about your equipment for a minute, which is not a current asset, but a long-lived asset or fixed asset. If you needed to sell your equipment to pay your bills, it might be a long process, and it might take away from your production capabilities. And the amount that you could fetch is very uncertain. So who uses this? The primary user of this piece of information is your banker. Your banker uses it to gauge how creditworthy your company is, and if they want to extend your credit or increase your available credit. Another user of this are investors, either current investors or potential future investors. Like the banker, the investor wants to know how safe an investment this would be. Where do you want this to be? Generally, the lowest number you want is 1.0. Below this, your current obligations are greater than the level of short-term assets that can normally be used to pay these obligations. In order to keep paying your bills, you would have to rob Peter to pay Paul. You would have to do a lot of juggling in order to keep going, and it is hard and risky. Banks know this and will not want you as their customer if this does not change quickly. Can a ratio be too high? Yes. What this means is that you are not being efficient with your money. As the manager or owner of the business, you should be putting money to work for you. You should be buying equipment to make more money. Or you should be paying off your long-term debts. If nothing else, you could give the money back to the investors or owners in the form of dividends or owner draws. If you do not have a good investment option within your company to turn that excess cash into more business, you should allow the owners to take that money and invest in projects on their own. How can you manage this? You have money tied up in your business, building, inventory, other assets. Based on how much you have invested in your business, you should be earning a good return to justify what you have spent. Your earnings need to generate sufficient cash. The main ways to influence the current ratio: manage normal expenses. Being able to pay less for the things that you need will leave more money aside to pay the bills. Pushing off expenses when you can. Adjust the timing. This will also give you more flexibility. Manage capital assets. If your ratio is too low, you should not be buying new expensive equipment. You can't afford it. If your ratio is too high, you should consider buying new equipment that will help the business. Manage long-term debt. If you have been using your line of credit consistently for some period of time, perhaps you need to move this to a long-term loan. This will allow you to shift some of the debt out of the current liabilities section. It might seem like pure gamesmanship, but it is more than that. It gives you the flexibility to manage your cash as the market goes through ups and downs. If you have a high current ratio and you also have long-term debt, consider paying off some of your debt early. This will lower your current assets, cash, and also have the benefit of lowering your interest expense paid to the bank in the future. Manage owner distributions. When you pay dividends, you decrease your cash and your current assets. You do not decrease your current liabilities. So paying dividends will lower your current ratio. If your current ratio is too low, you should hold off on paying dividends until you have built your ratio back up. Thank you and have a good day.